Nervous?
Yes.
First time.
No, I've been nervous lots of times.
Live from the basement of the YouTube headquarters, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and let's talk investing. International funds have trailed U.S. returns now for years. So can we finally toss that dumpster fire in the trash? We'll ask our roundtable of top minds. Top minds, I say. And of course, what do we do when we get these three around a set of mics? We ask them trivia questions to see who's going to win our year-long trivia competition. And now, here's a guy who thinks the only thing more volatile than the stock market is our contributors' trivia answers. It's Joe Saul-Sehy.
Hey there, stackers, and happy Friday to you. And they are, Doug. They're all over the place. I'm super excited that we're here today. Speaking of all over the place, we're going to talk about investing today. We haven't just hit the investing button straight on in a little while, so this is going to be a lot of fun. And let's say hello to the funsters themselves, starting with the guy across the card table from me. The Funster OG is here. How are you, man?
Oh, I'm just living the dream. One cup of coffee at a time.
Cup of coffee at 8 o'clock at night is difficult.
Also,
you still
a scotch.
Oh, perfect. There. Let them fight it out. That's perfect. And
they cancel each other out, don't they? It's like
it's
like
science.
Yin and yang. It's
totally
just
science. Yes. And the woman who's fighting it out every day in Manhattan from the Afford Anything podcast, Paula Pant, joins us. How are you?
I'm drinking bone broth.
Oh, is that some new alcohol I'm not familiar with?
No, it's cattle bones. You take the bones of a cow, you roast them in the oven for an hour, then you slow cook them.
I can see how you're slow playing this now, since people behind the scenes don't know that this is the second time you've described it. I can tell by everybody else's face, not yours, that you described this when my internet went bye-bye.
Yeah,
yes.
This time I'm taking it even slower and like being a little bit more visceral. You take these desiccated bones and then they're broiling and then boiling.
I'm now terrified of Paula Pant.
She's watching too many Dexter shows.
Yeah.
Paula Hannibal Lecter Pant, we call her. And the guy who's, he's got a snowscape outside his window because he's in the frozen tundra of the great New York North. Mr. Jesse Cramer's here. How are you, man?
I'm doing okay. I'm coming over a little cold, and since we're all sharing what we're drinking, I've got some Purell
bone broth
that I've been guzzling down. 90 kills 99.99% of germs. But other than that, things are good.
Third nine that gets you, though.
It is. It's that 1 in 10,000 germ that I've been infected with. But we're feeling better. We're feeling a lot better.
Jesse, this show goes live on the 21st. Have you renamed your show yet?
Yes.
Can you tell anybody what it is?
Episode 100 was published today, the day that we're talking here, the day we're recording. And this is I might have alluded to the fact that the title change was kind of for SEO purposes. Okay. Which some of you listening might understand, some might not. The podcast is now
You're just
called...
calling it the Joe Saul-Sehy podcast, aren't you?
It's the Amazon Google Money podcast.
Oh, I tell you, it's Jay Cramer investing. No, it's called Personal Finance for Long-Term Investors, which I know sounds super plain, but that's kind of the point. So that's what the podcast is now called. Personal Finance for Long-Term Investors.
There you go.
Personal Finance for Long-Term Investors. Is there like a PFFLTI? Could we just call it PFFLTI?
It rolls right off the tongue.
PFFLTI show. Yes.
Pafulty.
Flitty. Yeah.
The man behind the Pafulty podcast, Jesse Cramer's here. That's so good. Doug, what's your new podcast going to be called?
I would like a nap.
Best name ever.
It sounds boring, but that's kind of the point.
Nap with Doug.
Nap with Doug.
Perfect and creepy all rolled into one. We got a great show today. You know, international investing for over the last decade has really never been on the top of the charts when it comes to different asset classes. And so the question on everybody's mind and what inspired this discussion was a piece from the amazing Nick Majuli, who was just on our show about a month ago. But Nick asked the question, it's time to finally dump international investing. We're going to ask our esteemed panel today. But before we do that, we have some sponsors that make sure that this show is free. You don't have to pay for any of this goodness while you're taking out the international fund trash. You can just focus on that. We're going to hear from them right now, say hello to them, and then we're going to talk international investments and other asset classes. What asset classes do our panel? That's
the name of my podcast.
Los pantalones.
That's when you get all of my family on a panel.
The Paula Pant.
Yeah.
Yes. Does our panel not really pay much attention to, or do they stay away from? We're going to talk about that. So let's get this started. The inspiration for today's piece comes to us from Nick Majuli. It's the Of Dollars and Data blog. And if my computer was running quickly at all, I would read to you from the blog. But the big point here right now, Paula Pant, is that over the last decade, international really has been that thing in your portfolio that makes sure that you're mediocre.
Exactly. So Nick even talked about how he has held international funds for his entire journey as an investor, and that has meant that he's had lower returns than he otherwise would have had. That being said, the premise of judging a fund based on its recent performance, even if that recent performance is a decade, based on the principle of do you want these in your portfolio? I think that is something to suss out, because performance, even over the span of a decade, can be based on some short-term factors, but the notion behind diversification, and having a mix of assets that have low correlation with one another, there's some meat to that.
OG, it's interesting because Paul is talking about using international for diversification, and yet there's other asset classes that we don't care about when it comes to diversification. Is international any different than some of the other asset classes we might talk about that we decide not to?
What asset classes don't you use?
Well, let's talk about which ones you don't use. I don't think you use commodities in your allocation.
No, but the companies that do the commodities are certainly there. So we won't invest in gold, for example, but the company that manufactures or mines it would be a part of the portfolio. We don't invest in oil wells, but ExxonMobil or whatever, would be a part of the portfolio. I think, the benefit of diversification is, and especially when it comes to the idea of just asset class investing, is you get all of the return of all of the stocks, and you don't have to guess what's going to do well. I don't know why anybody would want to play that game, especially if you look at big, broad areas of the economy, like US versus international. I would anytime somebody says, well, I don't want to invest in international because it hasn't done well, I just want to put that on the next level extreme and go, well, why should we invest in anything other than the Mag 7? Those are the only ones that have gone up. Why would we invest in anything other than the S&P 500? It's like, well, because it's not always going to be this way. And I can't prove nor predict when that change might happen. But I guarantee when it does happen, it's not going to be foreshadowed. It'll be like, in the rearview mirror, you'll look and go, wow, I'm sure glad I own some of Chile. They did awesome. I'm sure glad I have some emerging market or international, because the US sucks all of a sudden for whatever reason. It's in a recession, and Europe is banger. So I'm glad I own some of that. It's no different than you would say with any other asset class. So I don't know why you would just arbitrarily throw out, a third of the economy or 40% of the world economy and say, I don't want to invest in that anymore.
Jesse, as an asset class, do you look at convertible stocks?
Convertible stocks, like Chrysler Sebring with a roof down.
That's exactly what I'm talking about.
Hey, that's a fine vehicle.
Ford Mustangs. Yes.
The short answer is no, Joe, not really.
So then how come, I'm just going to assume that you agree with Paula and OG, the international you shouldn't throw away. How come ostensibly you've thrown away convertibles?
You're talking about like, well, isn't convertible like a share class? Like, you can take
it's an
something
asset class. It's a hybrid between stocks and bonds, right?
Stocks and bonds, right? Well, you've got a fixed income with a lotto ticket attached to it. I think that's how Buffett talks about it. You get some sort of fixed income.
I think you answered your own question, Jesse. That's why I don't include it. It's not a thing. You know, it's convertibles, I would argue, is not an asset class. It's an amalgamation of a derivative of an asset class. It's smoke and mirrors. It's saying, well, I want this safety in exchange and I'll pay for this safety with the hope that this turns into something, right. You know, also fixed income sucks. So I would say that's
okay. There we go. Oh, gee, how about fixed income? Let's say bonds as an asset class.
We're talking about U.S. versus international in terms of equities. You're not talking about debt. And philosophically, if we owned fixed income, I would also say you should own international fixed income also. Yes, I do think so, because you can't predict the ebbs and flows of interest rates or US dollar versus euros or yens or whatever, you know, any different than you can predict what's going to happen with a US stock versus an international stock, you know? So if you invested in fixed income as part of your portfolio, let's say you were a 60-40 average investor, right? That 40% of debt, yeah, it should be diversified as well in big companies and small companies and, you know, highly leveraged ones and nice and secure ones. And, you know, and just the same way that you would do it for, you know, for your equity investing.
Paula, what I found interesting about this piece was that Nick kind of parses between international stocks where the headquarters is international. That's one thing. Getting international exposure, you can get that by staying in the U.S.
Many large multinational U.S. companies have footprints overseas. So if you think of Nike, Coca-Cola, Google, right? These are all, you know, major companies that have big footprints overseas. And the U.S. is not a huge exporter, but we do have locations everywhere, which, you know, on one hand, it does give us some international exposure. On the other hand, it isn't exactly the same in that it more so poses a risk to the U.S. companies in terms of how they will be taxed and treated by the foreign entity in which they are located. You know, it's sort of, yes, they have exposure to that consumer market. They're also subject to the laws and the regulations of the country in which they reside. And that whole set of circumstances is in many ways fundamentally different than a company launching elsewhere and then deciding to put an ancillary footprint in the U.S.
Jesse, do you own any international positions in your portfolio?
100%. I do.
100%.
He's 100% international. YOLO.
No, I own in my stock allocation. I mean, roughly speaking, you can think of it as being market cap weighted, meaning like right now, about 60% of the entire global stock market is US, and somewhere between 60 and 70% of my stock portfolio is US, and the other, call it 30 to 40% is international. Yeah.
Yeah, Paula, what percentage of your portfolio is international?
I don't know the exact percent, but I would guess probably ballpark 15 to 20-ish.
Oh, gee, how about you?
I think globally we're probably 20 or 25. Yeah.
Does it surprise you, Jesse, that Jack Bogle, the founder of Vanguard, said that he doesn't own any non-U.S. stocks?
Yes, it does. Only because one thing I was going to talk about today is his famous speech about the iron rule of investing, which is reversion to the mean. And it's an amazing paper. If anyone listening hasn't read it, it's definitely worth reading. John Bogle's paper on that, where he just talks about it's filled with all this amazing data that shows that outperformance never lasts forever, and that periods of outperformance are always followed by periods of underperformance. And that is the reversion to the mean. Everything comes back to average. And it goes back to what OG was saying earlier, that, you can't always tell when. And just because something is outperformed for a long time doesn't mean it's going to start underperforming tomorrow. And referring there to, the S&P 500 or large cap US stocks, or whatever you want to say.
Yeah, why do you think he goes against that then with his own money, saying, yeah, I understand reversion to the mean, but I'm not going to own any? Sure.
I mean, for Jack Bogle, does it make a difference? I mean, it probably doesn't make a difference at some point. You know what I mean? It's like, he's he was, before he passed away, a multi-billionaire. It probably doesn't matter whether he owned US stocks or not. He was going to be okay.
It's the same thing that Markowitz said about asset allocation. He knew that the right answer was 100% equities until he invested 50-50. Because human nature is human nature. It's like if you ask U.S. investors how much money is in the U.S., the vast majority is. If you ask Danish investors how much is in Denmark, they'll say the vast majority is. If you ask U.K. investors how much is invested in the U.K., the vast majority is. There's a significant home bias everywhere you go. That's uniform in almost every market and economy, which is why most people are comfortable with investing in the U.S. When you talk to U.S. investors, it's like, we're here. We know what we know. I have a certain feel about, the companies that are here, and, for good or for bad, I think a lot of people have that bent, no matter where they are in the world, to what they know. I mean, hell, there was who's the investor that said that? Invest in what you know. Like
Peter Lynch.
I don't know anything about NVIDIA, but I'm hella glad I got some.
And to clarify too, because he also said all the time that he gets misquoted on that people, people think, okay, I use Heinz ketchup, so I'm going to buy, I'm going to buy that. He's like, that should just be the top of your funnel. Like that's what you start with, and then whittle your way down to what an actual good investment would be. If we get all of it. It is amazing, Paula, digging into Nick's data here, that the rise of the United States over the past many, many, many years, 1990 to present, truly the two times where the U.S. has kicked ass, and maybe we've been more prone to have this conversation, is when U.S. tech stocks are absolutely rocking. Is this maybe is the fact that we're having this conversation now, and the fact that it's on everybody's mind, does that immediately make you think, talking about reversion to the mean, this is the wrong time to be having this conversation?
You mean, does the conversation around should we be investing in international stocks reflect either exuberance or distrust, depending on the position that you take about the tech sector specifically?
About tech specifically, yeah.
Yeah, I mean, certainly right now, if you're going to use recency bias, yeah, absolutely. You can, in some ways, conflate the overall U.S. stock market with the tech sector because there is such heavy current overlap. That being said, some of the most innovative projects that we've seen come out of other countries are also tech projects. I mean, look at DeepSeek that came out of China.
Never heard of it.
No. And so, we talked earlier about U.S. companies that have footprints overseas. The tech sector specifically does not need to have a footprint anywhere. It is, by definition, digital. And so there's likely going to be a lot of tech sector innovation coming from China, not just China, but from many countries around the globe. And so I don't think international exposure gets you away from it. If anything, it, depending on specifically the region you invest in, it might get you deeper into it.
What do you think, Jesse, when you hear these people on TV talking about, about valuations and about valuations in the U.S. and supporting, you turn on CBC or Fox Business, it's blah, 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 valuations support where we're at today. Valuations don't support where we're at today. And this argument, maybe half for, half against.
Well, yeah, I mean, the argument for the listener who's unaware is just that U.S. stocks right now, the price to earnings ratio or whatever kind of metric you want to look at, U.S. stocks seem overvalued, at least compared to historical standards. or the Robert Shiller's cyclically adjusted PE CAPE ratio is high compared to historical standards. And again, if you look at 10 or 20 or 30 year forward returns as a function of the CAPE ratio, you'd say, oh, when you have to pay more for a stock, then your future returns usually go down. And that just makes sense, right? If I had to pay $100,000 for a Honda Civic, it might not be a good investment. And if I have to overpay for my stocks.
But then again,
I know, but it might be cool.
You compare that to international stocks and you'd say, well, the PE ratio, or again, whatever kind of price earnings type metric you want to look at, is a lot more attractive. And again, not to beat a dead horse here, but that's going back to that whole reversion to the mean idea, where if you look at stock market history, you'd say, well, right, PE ratios certainly have been high before, and then eventually they come back down. And if that's what's going to happen in our near-term future, then you might not want to throw all your money in the U.S. stock market right now. That's the argument.
Boy, and that's a hard game to play, OG, because, you know, the second that we start talking about reversion to the mean and the fact the last 10 years haven't been that kind to international stocks, I'm sure there's people out there thinking, well, I think what the panel's saying is this is the time to back the truck up on international stocks.
I don't know that you can say that about international stocks or U.S. tech stocks if it's overweighted or whatever. I think you can say that about a bunch of different sectors. I mean, you could look at small company stocks and just say, well, heck, they're supposed to on average be better. And on average for the last 8-10 years, they've sucked, you know? So the thing about the whole concept of like trying to market time is that it's impossible to be right. You could guess, honestly, today could be the day that is the high water mark for the S&P for the next 24 months, and internationals go gangbusters, and you could guess right. But the reality is that there's no way to predict the future ebbs and flows of sectors, economies, countries, you know, subsets within sectors. Like, you just don't know. And there's plenty of people on one end of the extreme who have said, like, you know what, it's 2019. Freaking tech has done amazing. They're overvalued. Let's get out of that. Right. And then you miss the next 5 years of, you know, 100% return and, you know, all the benefits of that. There's no different than people saying the S&P as a whole is overweighted right now, and maybe we should be an international. I don't know. And I can't honestly say that anybody knows with any degree of certainty. So the only logical outcome here, or the only logical way to handle this, is to always be invested the same way all the time. And then when you have a period of time, like if you look at your portfolio in the last 12 months, you'd go, hey, my tech stocks or my S&P large cap growth has done well relative to its expected return. I expected 10, it did 20. Like, go me. That's awesome. My small cap stock did 8. I expected 13. So their only logical solution is to take a little bit of rebalancing, take a little bit of the profit from the large cap growth and put it in small, or from large cap and international, and every so often do that. And there's no evidence to suggest anything more frequently than once a year will be satisfactory there. And if you just do that over time, over your lifetime of investing, then you will work out to be have a good outcome, have a good expected return. When you start putting your own flavor in it and going, well, I don't know, I think tech's overweighted, and there's just as many studies that say it's overweighted that say, well, this is a momentum play and momentum continues. Like, it's going to keep going. Do you want to get in the way of a moving truck? You know what I mean? Like, there's as many voices on either side of that. You got to tune that stuff out and just say, nope, I do 50% of my money's in US large cap, and I'm at 52. So I'm taking that too, and I'm putting it in the thing that went down. Full stop. End of discussion.
And that is exactly what I want to talk about in the second half, guys. When it comes to different asset classes, how do you decide to tune some of them out? If you're making the argument that these asset classes work in different times, different economic conditions, why do we decide then to exclude some from our portfolio? I want to dive into that in the second half of this discussion, but at the halfway point of every Stacking Benjamins Friday episode, we have this amazing contest between our 3 frequent contributors. And man, it went from what looked like it was going to be a snoozer, Doug, to maybe a little bit of a barn burner now all of a sudden after we've got wins from Paula and from Jesse. So I believe our score then.
On weeks I was gone, magically somebody else won.
There's parity in the league, finally.
I think that the score then is OG 2, Paula 1, Jesse 1. Wait a minute. Does Jesse actually have a point, or did you award him for the mythological? I think you.
Jesse get an effort point?
I think Doug, you awarded him a point for last week when Catherine's internet went out. Jesse, do you have a point? I don't think you have a point.
No, that the trivia I won was the one where only two of us were guessing.
Right.
But I just think it's funny that OG, I mean, half of his point total is from Doc G, and he's up here on his high horse, like barking insults around, like he's really got a leg to stand on.
I forgot, Joe, that last week's was an unsanctioned trivia event where no scores would count. So you are correct.
I think, Jesse, if that would have gotten through, you owe Doug $10. I think that would have been, man. Yeah. Are you guys pointing at your trophies?
I'm pointing at my
Well, he just said I
bobblehead.
don't have a leg to stand on. And I was like, I don't know. That's a pretty big leg.
You could lean on last year's laurels. That's fine. That is fine.
Last several years, bro. Last several years.
I've only been around a few months.
All right. Well, the flame throwing, as you guys can see, has begun. We need a trivia question, though, with the score 2-1-0. Could Jesse get on the map? Is OG maybe going to back it up with some cha-ching? Is Paula going to be tied for first at the end of the week? How the hell would that happen? We need a question, Doug. What do we got on tap this week?
Well, hey there, stackers. I'm Joe's mom's neighbor, Doug, and please bow your head in silence as we remember a unit of currency gone the way of the greenback and the buffalo nickel. Yes, let's take a moment and remember the American penny. Okay, that's long enough.
Wow.
But in commemoration...
It's like the quickest moment of silence ever.
I mean, is anybody heartbroken? In commemoration of this moment, let's talk about some trivia that's about as weird as a $3 bill. The $3 coin. In what year, on today's date, was the $3 coin first minted in the USA? I'll be back right after I go plant a tree in memory of the penny. What will I put in those gumball machines now?
I don't think the gumball machines still take a penny. Doug,
are there gumball machines? They'll take like Apple Pay now, probably.
Ba-ding.
Lost in the 80s.
It takes a ba-ding.
Yeah. This is the day, by the way, that Congress passed that they would mint a $3 coin. What year was it? We start with the man in first place, OG. $3 coin.
Whew. So I feel like I know a lot about currency and I guess maybe coinage is my slip up.
You're current on your currency?
But I have never heard this before, so is there a chance that Doug's wrong? Is the answer Doug is wrong?
The answer is year zero because there's no such thing.
There is no year. Are we sure it's U.S. and not Canada?
Oh, good question. It's the U.S.
So Doug's pretty confident. Okay, U.S. All right, a $3 coin seems like something we would have done because I don't know why the hell we would have done that. Probably pre-vending machines. So I'm going to say so $1, George Washington, $2, Thomas Jefferson, $5, Lincoln. So somewhere between Jefferson and Lincoln, I'm going to say, because is that not the order of how they go? 1, 2, 5? No. And then, because then we go backwards to Hamilton. Dang it. Mm-hmm. And then Grant's in a different order. And all right. Jackson. Yeah, we're screwed. Doesn't Jefferson get 2? Because he's on the 2 and the 20? He's on everything that starts with 2. Who's on the 30? That would tell me. All right. I'm going to say 1841.
1841, Paula.
I'm not used to guessing second. This is weird.
Welcome to the new territory.
I know. It's the new year.
Well, it would have to happen at a time when $3 was valuable enough, but not too valuable. Because you wouldn't want to walk around with a $3 coin being like
Bunch of those
the
jangling in
value.
your pocket.
Yeah. Make you a target for robbery. Like if every $3 coin was the modern day equivalent of a $100 bill, and you had a pocket full of $3 coins, I mean.
Or are you just really happy to see me?
So, based on that, I'm going to guess a little bit more modern. I'm going to say 1910.
1910. Jesse, you got 1840 what, OG?
1841.
1841 and 1910, Jesse.
I was thinking, Reconstruction, post-war era. Some strange things happened in like the 1870s, 1880s. So I think I'm going to split the uprights here.
Post that war.
Oh, yeah. I think I'm going to split the uprights.
World War I was post-war.
What was it? 41 versus 1910?
Mm-hmm.
So what's splitting the uprights there? 1875? I'll say 1876 for good measure. Lock it in.
1876, locked and loaded. Well, we're all over the middle and the end of the 1800s and early 1900s. So, Doug, I think we might have stumped them. What year was it? We're going to find out in just a minute. We'll be right back.
I want to know when they stopped doing wooden nickels, because that's what my grandpa always used to say. Don't take any wooden nickels. And I was like, well, why would I? That sounds really crazy, but apparently that was a thing when my grandpa was young. So maybe that'll be your next trivia question. When did they stop making wooden nickels?
They stopped?
Doug, you just confounded Doug. Had no idea.
Doug's got a whole bunch of them. He's like, that's how I get paid. That's how we pay Doug in wooden nickels.
Yeah, we got.
Isn't your money supposed to float?
We shouldn't have brought that up. OG,
no, my bad.
OG, you had 1841. How you feeling now that all the ballots have been cast?
I don't think it was the 1900s, so we'll see.
Oh, throwing some shade at Paula. Paula, you feeling good about 1910?
I am. I have all of the upside, so I've got a wide section of
if it was 1992, you won.
Exactly.
You're fine. And Jesse, you've got all that room in the middle. How you feeling?
Feeling okay. I'm feeling okay. I do think, if anything, I think I might have overshot it a little bit. But we'll see where it comes out. We'll see where it shakes out.
Jesse at 1875, Paula at 1910, OG
76.
OG
76.
OG
76.
76. Sorry, 76. OG at 40, 1841. Doug, who's taking away the win today?
Hey there, stackers. I'm the guy who thought this show should have been called Dollars and Cents. Cents. Get it? And your penny lover, Joe's mom's neighbor, Doug. Ah, the penny. It's like we never really knew you. Sure, you lined the bottom of pockets, and purses, and wallets, but all this time it's because we thought you'd always be around. And now, what are we going to do at 7-Eleven without that need a penny, take a penny, filthy little bin next to the register, huh? It's just not going to be the same. But today we're talking about the $3 bill's weird cousin, the $3 coin. What year, on today's date, did the USA first mint this oddball gem of a coin? The $3 coin was first minted on today's date way back in... Buckle up, OG. It's your favorite part. Well, I'm not going to tell you the year, but I will say that Paula was just a scant 57 years off. Jesse was 23 years off.
Oh, my goodness. No.
And it was 12 years more recently than what OG guessed, because the correct answer is 1853, making the Merchant of Darkness our winner.
Merchant of Darkness.
Gotta have something out of the applause. Gotta have people like throwing stuff.
Boo.
Jesse, your gut was right. You overshot it.
Yeah. Wish I would have thought that when I actually had a chance to guess, but that's okay.
But you know now.
It's always next week, Jesse.
That's right.
There's
Always next week, buddy.
Thank you, Josh.
You're welcome, buddy.
Let's see if we can do better, though, Jesse. In the second half of today's episode, we're going to dive into other asset classes. So let's get into this. You know, you've all three kind of said that you think that people should use international stocks. What are some asset classes, Jesse, that you don't use? Well, pick one that you don't use for your goals, and why don't you use it? Sure.
Like at the end of the day, just because an asset class exists or just because like someone somewhere writes about something as an asset class doesn't necessarily mean that it has the economic, underpinning to justify investment. So what don't I own in my portfolio? Baseball cards. I don't own baseball cards in my portfolio because I don't understand the intrinsic cash flowing value that comes from owning a baseball card.
But the asset class that you're talking about when you say baseball cards is collectibles.
Sure. I mean, I consider, yes, that's fine. That is fine. Whether it's wine, art, baseball cards, or gold, I consider those all the same thing.
Easy, cowboy.
OG has to say into the mic that his wine is an asset class so he can write off all that drinking.
Contractually obligated. My banker needs my balance sheet every year, and I might have included that in my net worth statement.
Gotta have it. He's got to test the product mix for his investment. OG, what don't you invest in, and how did you decide not to? I love the idea, Jesse, of collectibles and the fact that I don't understand how or when they make money. Which ones do you stay away from?
Yeah, I think, broad brushstroke here with collectibles. I think artwork probably goes under that too. Some people find that valuable, to hold on to. I'm not smart enough I have a client who's a curator at a large museum, and I was talking to him about some artwork one time that I liked a lot. And I was like, hey, so some people are buying these and they're reselling them. And like, is this an investment? And the best news he gave me was like, listen, you own art because you like to see it. You own it because you want it hanging on your wall. You like it in your office. You like it in your den. You like it in your living room. It looks nice to you. If someone else down the line goes, that would look nice to me, and I would like to pay you for that. That is an ancillary byproduct. Do not buy this stuff because you think it's going to you're going to turn around and sell it someday. Obviously there's some masters out there, Van Gogh and stuff, but that's not the money I have. So asset classes that I don't presently invest in. Jesse already talked about Bitcoin. I have some. I don't consider it an asset class. It's a thing, but I don't necessarily consider it an asset class. I don't do any outside private equity, hedge funds, that sort of thing, largely because I believe it's not that I don't believe that could be a good investment. There's usually some limitations on investing in private equity, whether it's a net worth limitation or a liquidity limitation. I say, hey, you need to be able to, keep this money here for a long period of time. And that makes a lot of sense, right? If you're buying into a small business, or what private equity would be, a collection of small businesses, there's not that float. There's not the buying, you can't just sell part of grandpa's print shop because OG wants to get out and get his cash out. You know what I mean? There needs to be some sort of liquidity event. So part of it's that reason, the liquidity. Part of it is the lockup in terms of, how long you have to have it there for. And then the other piece of it is that I'm already a major investor in two businesses. I already have a lot of that. My net worth is largely invested in two small, very micro companies. And I don't know that I need to add any more to that asset class. In fact, one might argue I need to add more to the big companies, to offset the risk of the small one. But yeah, I'd say private equity. And for most investors, that's probably the main reason is the liquidity and net worth requirements.
I want to pause on that for a second. Paula, do you own any companies besides Afford Anything? Any private non-public companies?
No, I don't. I was asked to be an investor in one particular private company that I very, very strongly considered, and that I to this day think. Not that one. And to this day, I think it would have been a good investment, but I passed on it because it's also for the same reason I didn't want the liquidity lockup, particularly as a small business owner.
Sure. Right. Jesse, how about you? You own any private companies, piece of a company?
Nope.
I do find that interesting because it seemed to me when I was a financial planner, I would have people that would come to me. They'd be like, hey, my cousin's starting a restaurant. And you know what? We could put that money in the S&P 500, or I could put it in my cousin's restaurant, which will probably do a lot better. I'm like, or a lot worse. Yeah.
Yeah. I mean, again, if you just go back to like how it makes sense around investing, you put your money in the bank and you get nice, safe, secure 3% interest. It's going to be there tomorrow. You can take it all out in the afternoon, put it back in the next morning. It's 100% guaranteed to be there. And then you look at the leap from that to the S&P 500, right? The 500 biggest companies in the world. You accept some volatility for that, up to and including like minus half, right? We've seen that in our lifetimes of that's an exposure that we're okay with in exchange for 10% a year. Like that's the average. We'll take the 10%. Every so often we lose half, but over time it works out. And so you go back to like the micro company, right? Your brother's restaurant or something like that. You say, well, what must be the volatility and what must be the return for me to have this make sense? If the volatility is I could lose all my money, which is in a small company, an outcome, a higher outcome than, the S&P, then what must be the expected return? And I always caution people on this when they talk about it. I say, well, what do you think you're going to get out of the deal? Like, oh, I think we can, I might get 12% on my money. It's like, are you crazy? You need like 30%. Think about the banker who's lending money to the crappy credit rating guy and the guy with 850 credit score.
Well, I even think on a restaurant, it's got to be even higher than 30 because
whatever. Yeah. It's some multiple of what you get in the S&P because you're getting a zero as a terminal value sometimes.
Yeah, I mean, what's the lifespan of even a good restaurant, right? I mean, not the one that lasts forever and has been in the family for 40 years, but maybe 3 years, 4 years, it's going to be hot, 5 years, maybe.
11 Madison Park has been around for how many years? 10, 15?
Yeah.
20? They're not going to be around another 20 probably.
Not that long.
They're the best restaurant in the world.
Got to get a much, much higher return to get your money back out of it. Paula, to you, what don't you invest in?
So I don't have precious metals. I don't have silver or gold.
Precious metals not that precious to you.
Yeah, exactly. Exactly. I don't have precious metals. I don't
other than the bling you wear.
Yeah, I that's how I prefer. It's like it's on me. It's on me
your
at
drip.
all times.
You got to use the lingo, Paula. It's your drip.
It's my drip. I don't have commodities. I don't have cattle, other than the bone broth that I drink.
Other than the ones you murder and drink. Because you can't keep any around because you drink them all.
Don't drink your supply, whether it's wine or cattle.
She had a herd. Not anymore. It's all God.
Is this another ruminants? Is this a ruminant joke?
Yeah, I know. I keep ruminating on this. Yeah, I don't have wheat, corn, any of the above.
Well, and how come? I mean, how did you decide not to do commodities, precious metals?
Both commodities and precious metals I see as an inflation hedge, but I have a lot of real estate, which is also an inflation hedge. So I figure that's just too much inflation hedge.
But what's also interesting is, I mean, truly, and somebody said this when I was in Seattle a couple of weeks ago, said, stocks are an inflation hedge, right?
Yeah. Absolutely.
So it always kind of messes with me. And people talk about inflation hedge. I'm like, aren't stocks an inflation hedge? That's a big one. Speaking of that, Paula, you own real estate. Jesse, do you invest at all in REITs or any real estate?
Residential real estate. And in that way, like my house. And in that way, I've got this pretty large exposure on my balance sheet to a single housing project,
single
property, if you will. All right. So outside of that, no other real estate exposure currently.
No, real estate. Do you think at some point you will?
Potentially. My brother's a contractor here in Rochester, and I understand the numbers. So I feel like the two of us could put our heads together and be a pretty low cost residential real estate investing team. but it's a little ways down the road if we're going to do that.
I think it's funny when you take a look at an investment, OG, what's kind of at the top of your funnel? Somebody brings you, let's say, some investment they think is a good idea. Work us down the funnel from the top. How do you start by going, does this fit or not?
We've been getting a couple of these as of late, and well, my funnel is usually no. It's just like, yeah, no. I don't need it. There's no funnel. It's just no.
Boy, that sounds like Grandpa.
Yeah, it sure does.
He puts the narrow part of the funnel at the top.
Yeah. Is that not, it's not like a hat.
See if you can make it in. Shoot it from over there, from across the room. See if you can get it in.
I think that for me, everything has to start with what's the outcome that you're looking for from your portfolio. And this is, I think, a little bit more broader based, Joe, than your exact question. But sometimes, and we talked about this with the election, there's always the questions and anxiety that come with, now that blank happened, what do I do with my investing? And right now the narrative is all around politics and policy changes and that sort of thing. And so we're getting some of these questions, and it's like, well, did your goals change at all? If your goals haven't changed, then why would you change your portfolio? Like, what's the point of reacting to a short-term event in this big, broad, lens of your entire life and your family's life and your kids' life and grandkids' life? Like, this event, whatever you're talking about, is just one little drop in the bucket. So when I get pitched an investment, whether it's something personally or for our clients, I always just think like, what's the purpose of this? What does this solve that we don't already solve, through other things? And a real popular one is, and Joe, you remember this from your days, a lot of non-traded stuff, right? Private real estate or whatever. And it's like, well, what does this solve? It's, well, you get real estate exposure. Like, I already have that. I have equity real estate exposure. Well, this one, you get a tax form in August that you get to deal with. It's like,
I don't have that.
You got me.
That's what I totally need.
That's what I miss. Is I missed the K1 that comes August 1st after I filed my taxes 4 months ago. So I think the lens has to be, as you see these things, like, how does this fit in my plan as it relates to what goal am I trying to accomplish? And that's really where I would start. And then from there, you can work through like expected return, which is kind of the next piece of it. And going back to like the private business versus return, it's like, if I'm going to invest in my brother's restaurant or ice cream place, dude, I need some cash on this thing, because this is super risky. Because I get 10% in the biggest companies in the world, most professionally managed, the smartest people in the room. I get 10%. I get 13 if I go down a notch and go to the smallest companies in the world, still professionally managed, still the smartest guys in the room. And you want me to invest in your ice cream shop? I'm gonna need some major cash for that to offset that volatility potential of losing all my money.
Your board of directors names better be Ben and Jerry. Right.
Yeah. Well, no, you're not wrong. Right. Exactly. Like, what do you know about ice cream? Ben and Jerry said, hey, we're having an opening for investors. Right. That's a different thing. You go, okay, proven concept. They're not a small company, right? They're probably publicly traded at this point, but you get the idea. Yeah. You know what I mean? Yeah. You have a different expected return because of the market. So, but everything you have to start with your plan. Like, where does this fit?
Jesse, you were nodding. Anything else at the top of your funnel that you evaluate?
I was really nodding because, it really is that question of like, how does this investment fit the individual person's overall goals? And that's why, like, I know earlier there was a little touch on bonds, and we were talking about bonds and whether bonds have a place in a portfolio. And I know what it was. I think it was OG. You were talking about how if you were to own bonds, and how for you, you would make sure that they were internationally diversified, and you would own some bonds from really crappy companies, junk bonds, and other bonds from really good companies or something like that. And now I thought that was interesting. It's not like, to me, I own bonds if I need money in a certain, short-term time span. And so for me, when I own bonds in a portfolio, like, I don't necessarily want bad quality bonds in there. And I don't necessarily care if there are any international bonds in there. Like, for me, I'm not owning bonds to get any sort of excess return. And so for that reason, all I really care is that the money the principal value of the bond is there when I need it in a very specific time frame. But that just goes back to this whole idea of what's the purpose of this investment in my overall portfolio.
Jesse, I love that because I kind of like, in my book, I talk about the growing season analogy. I truly like thinking about when am I going to need the money, and then what investments historically have gotten me there most safely. It is funny how you and I have a similar approach that way, more of a risk management approach to investing. Paula, anything to add about how you pick investments?
I mean, so I have a barbell allocation. I don't hold bonds. I want my money to either be highly risky or totally safe. So I tend to go for the extremes, and that's not something I would recommend for everybody. It's just a personal choice.
And that is because why? I mean, what's the upside to doing it that way?
As a small business owner and as somebody who directly holds rental real estate, I have a need for having a lot of short-term cash on hand. And so because my bias is towards keeping a hefty cash allocation, just as a result of all of these things in my business and in my real estate investing life that I'm exposed to, because I have that hefty cash allocation, I want to put equities. I want all of my investable assets, market investments, to go into equities. Because
then over a short time frame, you don't have to worry about a need for money. You can go ahead and give them time. Got it. I think that's a great place to leave it. I find this very interesting, this whole piece, the discussion. I see this discussion all the time. Should I get rid of small cap value? Should I get rid of international? Should I get rid of... And I love the three of you really going back to, I think you got to examine the why behind why you have that in your portfolio in the first place. Speaking of the first place, this is the second place for two of the three of you where you are located. We're going to find out where that primary place is and what's going on. Well, we know where the primary place is. Sometimes I just start talking and I wonder what the end of that sentence is going to look like. And sometimes it goes my way, sometimes it doesn't. Let's just find out what the heck's going on where OG lives. OG, what do you got going on this weekend, man?
Well, presently I'm skiing with Doug, and he's tired of me by now. So he's skiing alone and I'm skiing alone, and it's working out really well.
You're no longer holding hands like at the beginning of the...
What he doesn't know is I'm already on a flight back.
Doug took the rental car and said, I'll see you in Reno.
Doug's sitting at the bar at the Keno machine in Reno.
Oh God, what a great thing to spend. That's what we should do.
Keno in Reno?
Keno in Reno, baby. Nope. And then it's baseball season. So we are elbow deep in varsity baseball. So
wow.
When not working, it's varsity baseball.
And Jesse, for you, there's only like 8 more weeks of winter left on the 21st. So
I grew up playing. Our baseball season here in upstate New York is it's a spring sport. So we play from early April through about early May. And that's the school baseball season. You get 5 weeks to play 27 games.
Jesse, did you play in high school?
I did. Yeah.
Yeah, I did too. And when you were a freshman, did you get made? There were a couple of weeks where to practice, they made us as freshmen go out and shovel the field off. Did you ever have to do that?
No, we didn't. But I mean, we would practice on like the high school gym floor. But on the nice days when it was still snowy and wet, but it was nice outside, you'd play in the parking lot.
This is scintillating.
Sliding in concrete sucks, I guess.
Yeah, we would try not to do that. It doesn't work out well, OG, if you've never tried.
That is painful. Just some painful baseball. Jesse, what's happening at the brand new under same management, but new name, Personal Finance for Long-Term Investors podcast?
We are... we're about to have an episode with Chad Carson and then another AMA coming out soon. And I think I'm going to do a deep dive on national debt. It sounds like it's a juicy topic that I want to really sink my thinking into.
Wow.
Let us know when you figure it out.
Yes. So are you going to say if the U.S. had an emergency fund and they didn't use the credit card so much, we'd be better off?
That's probably part of it. It's such an interesting thing because, right, like unlike us, the U.S. government just gets to print more money. except it seems like that probably has a logical end to it. So it's a deep dive.
But the cool thing is, Jesse, I'm sure they get to keep all the reward points from their credit card. I mean, think about all that.
That's what I've heard. I've heard that the president just gets to basically fly for free.
It's that whole jet of his is totally free jet that he gets with all those reward points.
Yeah. Air Force Chase 1.
Paula Pant, what's happening at the Afford Anything show?
On the Afford Anything podcast. So today is actually the final day of enrollment for our course on rental property investing.
You got to get in.
Right, exactly. Today is the deadline. So if you want to learn about how to invest in rental properties, today's your last day to sign up. affordanything.com/enroll.
And you've had a bunch of successful students go through that the last few years.
Yeah, we've surveyed our students, and 48.1% of our students, our graduating alumni, have gone on to buy at least one rental property.
That's fabulous. And you want to be in that percentage. Don't take any class and be in the other half. Go do it.
Exactly.
Yes. Yeah.
Yeah.
Well, and I'm sure among the other half, though, people still, building maybe the fund to do it.
Yeah, exactly. Building the muscle, building the funds. So we also survey our students on, from the time that you enroll in the class, what is your time frame towards when you want to invest in rental properties? And it's pretty all over the map. There are a few people, it's a little rare, but sometimes there are a few people who say, I just got a big commission or I got a bonus. Now I have too much cash sitting around and I want to deploy it. So I'd like to, put it towards a down payment. Like sometimes you've got that, but you've also got a pretty big subsection of students who say, hey, I want to buy a rental property. I'll be ready in like 2 years, but I want to get started now. Or I'll be ready in 3 years. I want to get started learning now.
And that is the link again is affordanything.com/enroll. And we'll have a link in our show notes at stackingbenjamins.com. All right, Doug.
Thank you.
That's going to do it for today, man. What should we have learned on today's show?
Well, Joe, here's what's stacked up on our to-do list for today. First, take some advice from OG when he said you should never, ever, ever own an international stock. Or wait, was it private equity? It was one of those, right, OG?
I said, if you're going to own something, make sure it fits in your plan.
Right. That's pretty much what I said.
Same.
Second, your North Star when it comes to asset class distribution is Paula's guidance about commodities. Paula, what was that again?
Don't drink your cattle.
Yeah, see? I'm nailing it today. But the big lesson? Don't ask Jesse if he knows any jokes about $3 coins. Who knew this guy could just keep them coming? Oh my goodness, Jesse, the goat, really? I mean, and then that one about the gynecologist? You crack me up. Oh my God, you're funny. Hey, thanks to Jesse Cramer for joining us today. He may tell you a joke or two about the $3 coin on his podcast called Personal Finance for Long-Term Investors, wherever you're listening to us right now. And you know what's as exotic as a $3 coin? Paula Pant Afford Anything podcast. That's what. Believe it or not, you can also find that goodness wherever you're listening to us today. We'll also include links in our show notes to both of these gems at stackingbenjamins.com.
And we did it.
What the hell with OG? Like, no love for him, but that's cool.
No, don't we just put that one in the pre-recorded one, or do you want me to read that?
I don't know, dude. I'm just kidding. I don't care.
This show is the property of SB Podcasts, LLC, copyright 2024, and is created by Joe Saul-Sehy. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamins Show.